If you've been paying student loans, I've got good news for you. You might be able to save money on your taxes, and I'm going to show you how to do it in under 10 minutes. No tax jargon, no complex forms, just real answers for real people. Welcome back to my channel. If you're new here, I'm Joe, a licensed certified public accountant with over 10 years experience in corporate and public accounting. I have an extensive background in accounting, audits, and taxes, and I'm all about helping you take control of your money and live smarter. Be sure to subscribe and turn on all notifications to our channel. And check out our blog site where we post every Monday, Wednesday, and Friday. Today, we're breaking down the student loan interest deduction, what it is, who qualifies, how much you can save, and how to claim it. So, let's get into it. So, first off, what exactly is this deduction? It's a simple tax break that lets you reduce your taxable income by up to $2,500 just for paying interest on a qualified student loan. You don't need to itemize your deduction. It's what us tax professionals like to call an above the line deduction, which just means it comes off the top of your income before taxes are calculated. Bottom line, it lowers how much of your income the government taxes. This can mean hundreds of dollars back in your pocket. This isn't a credit or a refund. It just reduces the income the IRS taxes you on. Let's take a look at how much you could save. Let's say you paid $2,000 on interest on your student loans this year. If you're in the 22% tax bracket, this deduction could save you about $440 on your taxes. That's money you get to keep, no extra work required. So what we'll do is we take the 2,000 that you paid on your interest and times it by 22%. And that's how we get the 440 that you can save. You've already paid the interest. Now let it work for you. To be eligible for the student loan deduction, here's what you need to check off in order to make sure that you qualify. You paid interest during the year on a qualified student loan. You're legally obligated to repay it. This just means that it's your name on the student loans. You're not claimed as a dependent on someone else's tax return. Your income is under the IRS's limit. We'll cover that next because there is a phase out depending on how much income you're bringing in. Even if your parents or someone else helped you to make payments, only the person legally responsible for the loans can take the deduction. Let's take a look at the 2024 income limitation set by the IRS. Again, this is just the 2024 income limit set by the IRS in order to qualify for the deduction. The 2025, I don't believe, was out when I went to do a little bit of research to see if they updated it yet, but that'll probably come out sometime in January. So, if you're single or married from a household, if that's your status, your filing status, if you made anything under $75,000, you'll qualify for the full 2,500 deduction. Now, if you made over $90,000, then you've already phased out. And anything between 75 and 90, you start to slowly phase out of taking the full deduction. Now, if you're married filing jointly, if your combined income is under 155,000, then you fully qualify for that deduction. Anything over 185,000, you no longer are eligible for the deduction you phased out. And anything between 155,000 and 185,000, as your income goes up, increases, you start to phase out again of this deduction. Just remember, only the interest counts, not the full payment. And the loan must have been used for a qualified education expense at an eligible school. Let's take a look at the next checklist. So, if you've paid interest on a federal student loan, certain private student loans, consolidations or refinance loans, graduate or parent plus loans, if you're legally responsible, then for um, they'll qualify for your student loan interest deduction. Now, if you pay $600 or more in interest, your loan service provider will send you a Form 1098E in January, February. Remember, not all student loans count, but most federal and private education loans do. So if you don't get that form in February or January, call your service provider and see if they'll send it out. and they'll be able to tell you whether you actually did qualify or not. Now, let's take a look at the other side of the coin and see what doesn't count towards this deduction. Now, this is what doesn't count. If you got a loan from a family member or an employer, you're just helping someone else pay their loans, you're claimed as a dependent that year, and you're not legally responsible for the loan. Also, if it took out a personal loan, not an educational loan, that doesn't count either. Remember, the IRS only allows this deduction if you're both the borrower and the payer. This means for formal student loans only, no side deals or personal arrangements. Now, let's talk about how to actually claim this deduction. It's actually a lot easier than you think. Alrighty, so how do you actually claim the student loan deduction? Step one is to find or get or call your service provider to receive your form 1098E. It's a tax form sent by your loan service provider and it should come around January, February. Step two is use either your tax software or a tax professional. Most, most tax professionals will ask if you paid any student loan interest during the year or if you received your form 1098E. Step three is to enter on Schedule 1 of the 1040. That's it. Simpler than what I taught you, huh? You don't need to itemize or do anything fancy. Just report it, and your taxable income goes down. Even basic online tax tools will help you ask you if you paid student loan interest. Just plug in the number. Now, let's take a look at some few extra tips to keep in mind. So, here's some things to keep in mind. Even small interest amounts can help. So, make sure you claim it every year. Save your 1098E in your tax folder for each year. Track your interest payments. If you're close to the 600 threshold, and if you're married, check whose name's on the loan. Only that person can claim it. This deduction can be big or small, but every dollar helps, especially when you're repaying debt. And if you combine this deduction with others, it makes it even better for your tax season. So, what's our final thoughts and actions to take away? Remember, if you're paying student loans, don't leave money on the table during tax time. You can really save some. Check your Form 1098E or call your service loan provider to see if you qualify. Remember, file your taxes every year with this deduction, no matter the amount, whether small or big. It'll help you to save money every year. To wrap it up, if you pay student loan interest, don't leave money on the table. The student loan interest deduction is one of the simplest ways to reduce your tax bill, and is often overlooked. Got questions? Drop them in the comments, and don't forget to like. Join me next week to look at how to file taxes after moving states.